I want to talk about a stock today that is just phenomenal in terms of its dividend growth. This is a stock that just recently raised its dividend by 20% year over year. I am talking about Starbucks. This is a high growth dividend stock. It's in my portfolio, and I want to talk about Starbucks today and its dividend growth. Hey everyone, this is Ian from ppcian.com. I am back with another video about dividend growth investing. Today's video is about Starbucks. This is a company that I own in my own personal portfolio that is raising its dividend rapidly. It is raising its dividend, in fact, 20% year over year based on its most recent dividend increase in Q4 of 2017. So Starbucks is an interesting one, and the reason I want to share this stock today is my channel is about dividend growth investing. I like to invest in stocks that not only pay a dividend and pay cash flow so that I can live off of that cash flow, but those stocks that raise their dividend aggressively year over year, because the quicker they can raise their dividend, the higher my yield on cost will become. So I took some notes, as I always do. Let me go into my notes here. Starbucks right now, it's trading at about $61.29. They're paying about 30 cents a quarter in dividends, which comes out to $1.20 per year. If you take the $1.20, you divide it by the share price. I actually didn't write this down, but the current yield, it's pretty low. It's sub 2%. It's in the high 1% range. This is atypical, actually, of the stocks that I own. Typically, the stocks I own in this market, the current yield is in the high 2s, low 3s, in that range, because the stocks have gone up a lot. But Starbucks, it's a little lower. It's sub 2. It's right around that high 1s range. And so the current yield on this stock, it's not very high. I'm not going to receive a tremendous amount of dividend income in the short run from this stock. But what's interesting about this stock is they're increasing the dividend really quickly. So when I actually need my dividend income to live off of, which is not now, which will probably be, 10 or so years from now, 10, 20 years out, that's when I start really tapping into this dividend income. If they keep raising the dividend as quickly as they have been, it's going to be quite interesting. It could be a component in my portfolio that is paying a really solid amount of passive income. So what's really interesting about this company is not only did they raise the dividend 20% in 2017, end of 2017, but this has been a track record for them. In fact, if you look at 2010, this was around the time when they first started paying dividends. In fact, they paid a total of 24.5 cents in dividend income that year. When you look at 2017, they paid $1.05. So if I take the $1.05, I subtract out the 24.5 cents that they paid in 2010, and then I divide that by the 24.5 cents they paid in 2010, I'm able to see that they have raised their dividend by 328.6%. 328.6% increase in the dividend in less than 10 years. This is just in 7 years' time. And so this is very atypical of a larger company. This is atypical of most stocks, quite frankly, that are in my stock portfolio. I own over 30 stocks that all pay dividends in my portfolio. And Starbucks is a very unique one in that they are just raising that dividend really quickly. And quite frankly, they're doing this because they just started paying a dividend and they're newer to the dividend game. Also, I would say their company is growing very quickly. We're going to get into that in a minute. And because of these two factors, they're able to raise that dividend very aggressively. And so you can see right here, 20% year over year in 2017 when you take the raise that they just did in late 2017, up 328.6% when you compare 2017 versus 2010. Phenomenal dividend growth. Now, what I want to share are some interesting scenarios, because let's cut right to it. As a dividend growth investor, what is really important, in my opinion, is yield on cost. Because most of us, myself included, when we start investing in dividends, we don't need that passive income right away. We're trying to build a snowball effect. We're trying to build a portfolio that one day can pay for everything, but right now we don't really need it. So fact of the matter is if the current yield is sub 2%. If the current dividend income is not huge, that's okay as long as the dividend income, the dividend yield keeps increasing. And so what I like to look at is this metric called yield on cost. And so I ran 3 scenarios here, 3 models. The first one assumes this 20% can hold up. For 10 years, year over year over year, they keep raising the dividend by 20% per year. The second scenario looks at a more moderate 15%. If they raise the dividend yield or the dividend payout 15% year over year over year for 10 years. Last scenario is 10% growth. If compounding over 10 years, they keep raising the dividend 10% each year for 10 years. So looking 10 years out from now, scenario 1, one's yield on cost is 12.1%. Scenario 2, 7.9%. Scenario 3, 5.1%. This, folks, is the power of dividend growth investing. It's not about the current dividend yield. My current dividend yield on Starbucks is less than 2%. But if I hold this thing for 10 years, if I do nothing, if they just keep raising the dividend 20% each year and it keeps compounding for 10 years, my yield that I'm receiving on my cost basis, it's no longer going to be sub 2%. It's going to be 12.1%. If they can't do that, let's say things slow down a bit. Let's say things have been really aggressive. They're going to have to taper it down. Let's say each year they can only raise the dividend by 15%. If they do that for 10 years, it compounds year over year over year. 10 years out, I am yielding not 2%, sub 2%. I'm yielding 7.9% on my cost basis. That's fabulous. And let's say it really, really slows down. I would say this is the worst case in my opinion, and it's just my opinion. I'm looking at 5.1% yield on cost. And this is the way I like to look at it. 10 years out, it's going to be somewhere in this range, between 5.1 and 12.1. I don't think it's going to be a lot greater than 12.1. But the fact of the matter is my yield on cost, when I need it 10 years from now, it's going to be in a range that is just fabulous. And I'm going to be receiving my dividends from a world-class company, from Starbucks, a company that I believe is going to be around for the long term, a company that I believe fulfills a great need out there. It gets people out into Starbucks, having a good time with friends and family. As long as one enjoys Starbucks in moderation, it's just a great thing. And so I like having brand name companies like this in my portfolio. So I want to look at just a few of the metrics behind Starbucks today. We've talked about the dividend growth, but what are the numbers that are supporting this dividend growth? Now, this is not an exhaustive analysis. It's just a start, but it's a few factors that I looked at in preparing today's video. First and foremost, I looked at the debt. How much debt does Starbucks have? It's only $3.99 billion. This is very low. Very, very low for a company. I didn't look at the market capitalization, but it's in, I'd say, the 80 billion plus or minus range. It's up there. So 3.99 billion, not very high. I'm very comfortable with that. I like companies with low amounts of debt. Their net margin is 12.89%. This is a good margin for a company like this that is in the restaurant industry. Great margin. And I like to look at margins industry by industry. Certain margins in industries like technology are going to be a lot higher. Other industries are going to be lower. I would say restaurant industry is going to tend to be on the lower side. So 12.89% net margin in the restaurant industry is fabulous. We already talked about this a little bit, but I love companies that have a brand. Starbucks has one of the most iconic brands in the world. And so not only am I getting the dividend growth, not only am I having the promise of a dividend yield on cost somewhere between 5.1 and 12.1% 10 years from now, and that's 10 years from now, everyone. What's it going to be 30 years from now? That's where it gets really interesting. But anyways, 10 years from now, I'm going to have a huge yield on cost, but I'm getting it from a company that I love, company that I support, one that I consume, I enjoy, I think is a great brand, as long as it's consumed in moderation. What else? The payout ratio right now is 50%, 50.76. Payout ratio is the amount of net earnings that are going out to dividends. So even if earnings don't grow, which I believe they will, the payout ratio is low enough where they can sustain more dividend growth. So That being said, what's really important for these types of companies, for companies that are growing their dividends really rapidly, are strong metrics on the income statement. And I've done a video recently on the income statement. If you want to learn more about it, I'll link to it in the description below. But the two things I looked at are revenue growth and earnings growth. Revenue growth, when I look at 2012 versus 2016, I just looked at the annual report. I picked up the 10K on Starbucks Investor Relations website. Revenue is up 60%. When I look at the same period, 2012 through 2016, the earnings per share are up 111%. So the trend here is in favor of growth. Surely Starbucks has probably reached a critical mass where they're really going to have to push internationally. I know they face some challenges internationally. They're probably going to have to continue to do that to grow. I think same-store sales can only grow so much. They will probably continue to grow, but they're probably at a critical mass where growth is going to be more difficult. That being said, the numbers that I'm looking at here in recent years are showing promise. And so if one wants to see this kind of dividend growth, they're not going to achieve it through increasing the payout ratio alone. They're going to achieve it by growing revenue and earnings. And the all indications that I see is that that is a possibility. It's a strong possibility. And so I like that about Starbucks. So before I close out today, I really want to talk about the composition of my portfolio. I own over 30 stocks. In my dividend stock portfolio, there are three types of stocks. There are stocks that have a really high current yield and very low dividend growth. There are stocks that have a moderate current yield and have moderate dividend growth. And then there are stocks that have a lower current yield but rapid dividend growth. Starbucks falls into the third bucket. This is a stock that has a lower current yield and rapid growth. By the way, a stock in the first bucket, like a high current yield and lower growth, I'd say those stocks tend to be utilities. I'd tend to see a current yield in maybe the 5% range, but it's not growing quickly. I would say stocks in the middle bucket tend to be like a consumer staple. Talking about Procter & Gamble and Kimberly-Clark in my last video, I'm going to link to it in the description below. Those tend to be kind of in that moderate bucket. They have a moderate current yield, moderate dividend growth. Starbucks in the third bucket has that high dividend growth. And for me, in my dividend growth portfolio, I like to mix and match all three of these buckets. I think it's important to have all three. I like to have a little bit of current yield, and that comes from bucket one. I like to hedge my bets and de-risk my portfolio. That comes from bucket two. I like to have a little bit of that growth, that strong growth, that opportunity to get a huge yield on cost. And that comes in bucket three. And quite frankly, even if things don't materialize with Starbucks, let's say same-store sales are flat, let's say revenue growth dries up, earnings growth dries up, even if they come to a more moderate level of growth, I believe scenario 3 is probably in the cards, in my opinion. So even in a poor situation, 10 years from now, I'm going to be yielding that 5% yield on cost from a world-renowned brand, and I am comfortable with that base case. So just a fun video today. I know a lot of questions come in about dividends, and especially growth of dividends, dividend growth. So this is particularly why investors like myself and others look not only at current yield, but growth. It's all about dividend growth investing. If you enjoyed today's video, I please invite you to like the video, to comment, to subscribe. All of that means the world to me. It fuels the growth on this channel, my growth, the ppcian channel growth, and I want to keep growing this channel, providing great value out there to YouTube and beyond. If you want to engage with me, please leave a comment. I try to answer all of them. Also, I am on Twitter, and so if you want to head over to Twitter, I will link in the description below to my profile on Twitter. Please go there. Feel free to reach out. I don't really look at direct messages, but if you message me publicly, I will look at those. I will see them, and they will be out there for everyone else to see as well. So I really appreciate that support here on YouTube and beyond. Before I leave today, in terms of full disclosure, I own Starbucks. I am long Starbucks. I also own Kimberly-Clark and Procter & Gamble. I am long on both of those positions as well. In terms of a friendly disclaimer, today's video is not investment advice, and I am not a licensed investment advisor. Today's video is just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. I hope you enjoyed the video today. I will see you all in the next dividend investing video.